Hey, welcome. When you look at the world of trading, the charts can just look like total chaos. But what if there was a tool that could help you cut right through all that noise and actually see what's going on? Well, today, we're going to break down one of the most fundamental indicators that does exactly that, the moving average. Let's dive in. So you're staring at a chart, right? Prices are bouncing up and down all over the place. How in the world do you make sense of it? How can you tell if the market's in an uptrend, a downtrend, or if it's just chopping around sideways? It's really the fundamental question every single trader has to figure out.
The answer is actually pretty simple. It's about simplifying. We need an indicator that can take all that crazy, erratic price movement and just smooth it out into one easy-to-read line. And that right there brings us to the star of today's show, the moving average.
So what is this thing exactly? Well, a moving average, or MA for short, does just what its name says. It calculates the average price over a set period of time, say, the last 20 days or the last 20 hours. Its entire job is to filter out all that short-term market noise and give us a much clearer picture of where the market is really headed.
Now, you're going to see a few common settings pop up all the time. Shorter ones, like the 20 period, are awesome for seeing the short-term trend. But the longer ones, like the famous 200 period MA, show you the big, long-term picture. And that 200 MA, oh yeah, that's the one the big institutions are watching. It's like a key health check for the entire market.
All right, so let's get practical. The number one reason to use a moving average is super simple, to identify the trend. And we're going to break this down into three simple but really powerful techniques to do just that. First, where the price is compared to the MA. Second, the actual angle or slope of the MA itself. And third, how two different MAs play off of each other.
Okay, this one is about as straightforward as it gets. If the price is consistently trading above the moving average line, you're in an uptrend. Simple. You should be looking for chances to buy. And if the price is consistently below that line, well, that's a downtrend, and you should be on the hunt for selling opportunities. See? Super easy.
But what happens when there's no real trend? In those sideways, choppy markets? Well, the price will just whip back and forth, crossing over the MA again and again, kind of like a pendulum. When you see this happening, that's your signal to be patient. Honestly, it's often best to just stay on the sidelines and wait for a clear direction to show up.
Okay, here's a pro tip for you. Try putting two MAs on your chart at once, a short-term one like a 20 and a long-term one like that big 200. This gives you a much clearer picture. And here's the thing, this combo doesn't just help you find better trades. Even more importantly, it helps you avoid the bad ones by making sure you're not trading against that powerful underlying long-term trend.
Next up, let's talk about the slope. The angle of the moving average tells you a ton about the strength of the trend. A really steep slope, something close to a 45-degree angle, that screams strong trend. Think of it like a rocket ship. That's when you might get more aggressive. But a gentle, shallow slope, that's a weaker trend, and it's telling you to be a lot more careful.
And our third technique for spotting the trend is to compare a small, fast MA with a larger, slower one. It's another great confirmation. When that smaller MA is floating above the larger one, it confirms you're in an uptrend. And when it dips below the larger one, that confirms a downtrend. It's just another piece of the puzzle to give you more confidence.
Okay, so we've got a handle on how to find a trend. But what about when that trend is about to die and turn around? So let's move on to our second key use case, which is spotting those potential reversals.
Now, the most basic signal for a reversal is a simple price crossover. When the price literally cuts right through the moving average line, it can mean the trend is changing. But, and believe me, this is a very big but, this method is famous for giving you a ton of false alarms, especially in those choppy sideways markets.
So, what's a better, more reliable way? The MA crossover. Instead of just watching the price cross over one line, we watch for a smaller MA to cross over a larger MA. This is a way more confirmed signal, it's super popular with traders, and it does a much better job of filtering out all that misleading market noise. So here's what that actually looks like. When that fast line crosses above the slow line, that's your bullish signal. It's a hint that a new uptrend might be starting. And you guessed it, when the fast line crosses below the slow one, that's your bearish signal, warning you that the good times might be over. And that brings us to our third and final use. And honestly, this might be one of the most powerful ways you can use this indicator. We're talking about using the moving average as a dynamic level of support and resistance.
See, unlike a regular support or resistance line that's just a flat horizontal line on your chart, the MA moves right along with the price. In a strong uptrend, it acts like a moving floor or support where the price will pull back, touch it, and then bounce higher. In a downtrend, it acts like a moving ceiling or resistance where the price often rallies up to it and gets rejected. That's what makes it so useful and dynamic.
So, what's the big takeaway here? Well, this gives you a potential game plan. In an uptrend, you can start looking for buying opportunities when the price pulls back to that moving average. And in a downtrend, you can look for selling opportunities when the price rallies up to it. The moving average basically becomes your action zone.
All right, that was a lot, I know. So let's wrap it all up with the key takeaways so you can start putting this stuff into practice.
Just remember these 3 main things. First, use it to identify the trend. Check the price position, the slope of the MA, and how 2 MAs are lined up. Second, use it to spot potential reversals, and remember to use the more reliable MA crossover. And third, use that MA as a dynamic area of support or resistance to find great potential entry zones.
So there you have it. The moving average is an incredibly powerful tool for bringing a little bit of clarity to all that market chaos. The real question now isn't about the tool. It's, now that you have it, how are you going to apply it to the charts you see every single day?